I'm Kara Murphy, and this is Money with Murphy. In 2022, fixed income had one of the worst years in memory, with one broad benchmark of bonds dropping 11%. So let's talk about what's happening this year in bonds. One major driver of bond returns tends to be credit, or how likely are companies, municipalities, mortgage holders, and others to repay their loans. When the economy grows faster, that ability to repay improves and bond prices tend to rise, all else equal. Interestingly, so far this year, high yield bonds are up almost 7%, while corporate bonds have increased almost 4%. Not bad considering declines of 11 and 15% respectively last year. What this tells us is the market has grown less concerned about companies or other entities paying their bills. Another major driver of bond returns are changes in interest rates, or the yields on treasury bonds. As rates go down, bond prices go up, and vice versa. In 2022, rates on short-term bonds and long-term bonds rose, driving down bond prices significantly. This year, though, it's a bit more complicated because not all rates have moved in the same direction. Short-term rates rose significantly, driven by the Federal Reserve, while long-term rates were flat or even declined. So if you're an investor in bonds, what does this mean for your returns? To really answer that question, you have to understand one other driver of bond returns, and that's the coupon or yield. When you first buy a bond, how much is that issuer promising to pay over the life of the bond? If that coupon is high, then a bond investor can earn a sizable return even as interest rates increases or credit spreads widen. At the start of 2022, bond yields were quite low, such that when rates began to rise, coupons didn't provide much of a cushion. By the beginning of this year, though, yields were much higher. Then, as rates rose further, bond investors still enjoyed positive returns. In fact, government bonds have returned about 2% so far this year. To bring it all together, after a pretty dismal year last year, bonds have started to show some life. Credit-sensitive issues have performed the best as economic growth was stronger than expected, while Treasury bonds have provided modest returns despite continued increases in rates. Going forward, we continue to expect positive returns in fixed income from a combination of a normalizing yield curve and an end to Fed rate hikes. Until next time, invest wisely and live richly.